It's that time of year again, and you've probably already given all your tax documents to your CPA. Taxes are the kind of thing where knowing just a little bit can help you ask the right questions and save you a lot of money. So let's do a deep dive into how taxes actually work in the United States. First, let's talk about your federal income tax. There are two things that you need to know about your federal income tax. First of all, it's progressive, okay? And we're not talking about political parties here. It just means that if you have high income, you are going to pay a high tax rate. You might be paying close to 50% if you're in the highest income brackets. And if you have low income, so if you're making $10,000 a year, then you're probably not going to pay any taxes at all. Okay, so it's progressive. That's what that means. The other thing is something that I like to call, it is bucketed. Okay, and I'm going to illustrate for you what that means. I want you to imagine that we have three different buckets here. This is going to be our 10% bucket, this is going to be our 12% bucket, this is going to be our 22% bucket. And in reality, there are like 7 buckets, but we're doing this for simplicity. Okay, now I want to imagine that you have a little water spout right here, and the water coming out is income. Okay, so the first bit of income is going to be taxed at 10%. If you're married, that amount is probably about $20,000. Make $20,000 taxed at 10%. And then the next, about $80,000 is going to be taxed at 12%. And then the next 100,000-ish are going to be taxed at 22%. So why that's important is because if I make $100,000 a year, not all of my income is taxed at 12%. 20,000 of it is taxed at 10%, and then 80,000 of it is taxed at 12%. And that works all the way up. So I can, like I said, I can be making $1 million a year, and I can be in the 37% tax bracket, but the first $20,000 of my income is still going to be taxed at 10%. So progressive and bucketed. Okay? So let's stop thinking about the federal government and think about our states that we love so much, okay? So I live in the state of Utah. So in Utah, we actually just have a flat 4.55% tax, okay? This makes our lives a lot easier, but it's not perfect, okay? So any income that you get, no matter what the source, the state of Utah wants 4.55% of that income. So whatever that 10%, 12% federal income tax you had before, add 4.55% to it, okay? All right, so now that we've done our federal taxes, we've added 4.55% to them. Some of you are going to say, hey, Luke, I actually looked at my paycheck and I only make $100,000 a year, but they're pulling out a whole lot more than 12% before it comes into my bank account. And that's where something tricky called FICA comes in. Okay, all that you need to know for FICA, it's an extra tax on wages. Extra tax on wages. Okay, and it's split up into 2 parts. Each of them is going to be 7.5%. And this one is going to be paid by you. This one is going to be paid by your company, whoever's paying you. Okay? So, from every paycheck that you get, even if you're in the 10% tax bracket, you're going to get 7.5% withheld to pay FICA taxes. Okay? And your company is going to pay the other half, the other 7.5%. Now, an important thing to note here is that if you and your company are the same, which is to say you're self-employed, you have your own business, or you're a contractor, in that case, you have to pay your 7.5% and your company's 7.5%. And if you don't, when you go file taxes in April, you're going to have a big tax bill, a 15% tax bill looking at you from there. So we got our federal tax, we got our FICA, and we got our state tax all compounding on each other. But some of you might know is when you actually go to file your taxes, there are more things that happen. So there are two types of ways that your taxes get reduced. The first is called a credit. So let's say I have $10,000 of income. Okay, if you remember from before, $10,000 of income is going to be taxed at 10%. Okay, if I'm married filing jointly, and then I'm going to take this $10,000 at 10%. That means I have a $1,000 tax. Okay, now what a credit does is it directly reduces the amount of tax that you're going to pay. A $500 credit means that you only pay $500 in taxes. Okay, some common credits are credits for having kids under the age of 17, credits for going to college and getting a bachelor's degree. Those directly reduce your taxable income. Okay, so that is different from what is a little bit more common called a deduction. Okay, same scenario, $10,000 of income and $1,000 tax bill. Okay, 10%. All right, now a deduction of $500 doesn't apply to your tax bill, it applies to your income. So let's say I get a $500 deduction, okay? So I'm going to take my income down here, I'm going to subtract $500, and I'm going to get an income of $9,500. Multiply that by 10%, and now my tax bill ends up being $950. Now notice, a $500 credit helps you a lot more than a $500 deduction. But credits don't come around quite as easily. For instance, if you're married, you automatically get a $30,000 deduction on your taxes just for existing. Okay? So, just for existing, if I have $30,000 of income, I get my $30,000 credit and my income becomes zero and I pay zero taxes on it. So now you know the basics of how taxes work and maybe even the basis of some tax saving strategies that you can use to help yourself next time you sit down with your accountant. If you thought this video was helpful, I would really appreciate it if you liked and subscribed. And if you're looking for a financial planner that can not only help you with investments, but also help you save money in taxes, feel free to reach out to me. Contact info is in the description.